you have a practice or are you running a business? Valuation is the ultimate KPI.
Hey there, welcome to another episode of the Valuations Podcast, brought to you by Truelytics, the premier business transition platform for the wealth management industry. My name is Mike Langford, and I am the host of the Valuations Podcast. And this week, I'm joined by Kirsten Bayer-Petras of Oak Street Funding, and our conversation could not be more timely for the news that dropped recently, and that is that 40% of all financial advisors currently working in the industry today will be retiring in the next 10 years. Let that sink in for a few minutes. 40%, that's kind of getting close to half of all financial advisors are going to be exiting the industry in the next decade. Now, of course, that's where Truelytics comes in as the premier business transition platform for the industry, right? But there's going to be some mechanics behind the scenes. And in many cases, it's going to be some money changing hands, right? Advisors don't usually ride off into the sunset and say, thank you very much. I'm retiring. I'm out of here. You guys keep all my clients and all the money that comes with it, right? Usually there's a transition, and that transition involves money. Right. So either an internal group of advisors or an individual advisor is going to acquire that book of business and there'll be some cash exchanged, or an external buyer is going to come in and buy that business. Now, whether that business is an individual advisor's business or a large RIA with many advisors underneath that roof, but something is going to happen in these next 10 years where many advisors are going to leave the industry. And then many other advisors are going to look to scale up and acquire those businesses, or younger advisors are going to look to grow via the tried and true process of being an apprentice and taking over the master's business, if you will, to borrow a term from like a plumbing and other trades and so forth. So really interesting and timely conversation with Kirsten. She's really smart, had a lot of great anecdotes and some really great experiences to share with us. So I think you're really going to love this episode. As always, make sure you do subscribe to the podcast on iTunes, Stitcher, SoundCloud, so you don't have to worry about missing an episode. We're also always open to hearing your feedback, your requests for topics and so forth. So send those in at valuations@truelytics.com or catch us on the socials. We're on LinkedIn, Twitter, Facebook. And of course, you could always swing by truelytics.com and fill out that contact us form and send us in some suggestions there. Okay. Well, enough of my intro. Let's get into it with Kirsten Bayer-Petras. Hi, Kirsten. I really appreciate you joining me for this show. It's great to have you. How are you doing today?
I'm doing great. Thanks for having me, Mike. We're enjoying a beautiful month of May here in Indiana, where we celebrate a little car race you might have heard of called the Indianapolis 500, which will be coming up this weekend. So we can't be better here in Indiana.
That's very cool. So I've been to Indiana once. I landed in the Indianapolis airport there, and I was really taken back by like how much of that airport is like dedicated to the pageantry of the race. And it makes sense, right? It's like the biggest event in town.
It certainly is this month, the biggest event in town. And it's a great tradition here. And I did not grow up here, but certainly got completely into it in my adult life. And I don't want to be anywhere else in the month of May besides Indianapolis, Indiana.
That's fantastic. It's a wonderful sports city too. I love how you have your, the basketball stadium and the football stadium are right downtown there. So it's really easy to access and so forth. It's, kind of walk from place to place. It's fantastic.
I agree. We had a great time when we hosted the Super Bowl here, and being able to walk around everything made it an ideal setup to entertain hundreds of thousands of people that came into town that week.
Very cool. So is there an actual Oak Street for Oak Street Funding?
That's a great question. If there is, it's not the street we're on.
I have a feeling that I got my career started. I used to work for a company called State Street, and it's a large custodial bank in Boston, and none of their offices, I think they might have kept a tiny office still on State Street in Boston, but my office, which was in the headquarters, was on Franklin Street. So it's kind of the same thing. Like as a business grows, very often they move from the place of origin.
Yeah, well, within our organization, transportation certainly seems to be a theme. We're Oak Street. We have a secured portal called My Street. We put out a publication called The Bridge. So getting places is definitely part of what we're trying to do with people around here.
That's great. That's great. Well, I'm really thrilled to have you on the show because, what you do at Oak Street and the service you provide is really top of mind for our community at Truelytics, right? We're serving the wealth management industry, and whether that's at the firm level for independent broker dealers, asset managers, large RIAs, and even every once in a while touching the individual advisor space. The thought, the concept of acquisitions, right, of the financing necessary to acquire a business or to sell a business or to facilitate the transition of a business from one advisor to another or a group of advisors to another group of advisors is always top of mind because, that's what we do at Truelytics is really focus on advisors' transition management. And so I thought it was going to be great to have you on the show and kind of dive in a little deeper. But before we kick off into things in detail, I thought I'd like to do a little bit of an IMDb dive on every guest you have on the show, kind of, your internet movie database of you and the business, kind of how you got here, right?
Right.
It was funny. I was talking to somebody else earlier this week, and we were talking about watching Game of Thrones, right? And the big finale happened this past weekend, and we were talking about how you can't watch a show anymore without having your iPhone right next to you and looking up who's that guy? What's that lady been in before? Or what's their next project, right? So it's really kind of fun, I think, to kick off the podcast with every guest to kind of do a little bit of dive. So if you wouldn't mind, let's share a little bit about your career and how you came to be at Oak Street and a little bit of history of the firm, if you would.
Yeah, certainly. And just to echo what you're saying about Game of Thrones, I get exactly what you mean about wanting to look things up. And particularly to that show, you're even looking up the history to these families that are all fictional in nature and just trying to get a better understanding of where that show's going. That being said, I am not as exciting as Game of Thrones, although I guess you could say I'm as exciting as that finale was. But I started off in my youth, early 20s, being fortunate enough to work at a local true community bank. And those are far and few between right now with all the consolidation that's occurred. But that experience really set the stage for where I am today, because when you work in that kind of environment, you touch everything and you learn all aspects of not just banking, but lending. And so from that, my focus got more and more narrow to lending and then consumer and commercial lending. And about 7.5 years ago, I found myself here at Oak Street. And what intrigued me about coming here, and when I joined, I was in a frontline relationship management role. At that time, I was largely working with insurance agents whose needs for borrowing were less than $1 million, primarily because that's where the company was positioned then, with the main focus there. But at that time, on the forefront of the expansion we've experienced over the last 7 years. But with that, what I found so interesting about what this company does is not necessarily that they lend to this niche type audience of advisors or insurance agents or even CPA firms, but rather how they lend. It is a very unique approach to assessing the value of the business, creating a blueprint, if you will, from the recurring revenue streams that they throw off as a result of the relationships that the advisors have. And then we design debt around that. That is unlike anywhere I've ever worked as a lender. And so I was truly intrigued. And I did not believe they said they were doing what they were doing when I was interviewed. And I thought, well, I'll go there for 90 days and they'll like me or I'll like them. Everybody kind of gets a probationary period of 90 days when you're going to a new job, I think. And I was hooked within the first week as I really started to understand how Oak Street lends to these borrowers who have very valuable businesses that traditional lenders just can't grasp and understand how to collateralize debt with. And so that approach and the way that they do an analysis on the books of business, and then from there, just the rapid expansion that we've experienced as an organization is what then laid the path for my own personal growth here, from frontline to management to director, leader, to now being the executive director of the sales team here at Oak Street that focuses on lending to advisors and insurance agents and CPA firms.
I think you really hit something that's super important for a listener to take in, right? It is that the financing for this industry, and this industry in general, when you think about it, is unlike very few other industries in the world, right? Very few other industries have the recurring revenue on virtually no assets that the wealth management industry has, right? Right. Most businesses have some sort of assets, and if you and most lenders are looking for some collateral to base their base their lending on, right? Like, show me the assets you have, show me the building, show me the equipment. And when you're looking at an RIA firm, they have in most cases none of that. Right? We have got relationships with clients. We've had these clients for a long time. We're looking to acquire somebody else's book potentially, and they've had those clients for a while, and we're hoping to keep those clients and keep that revenue stream coming. And to your point, very few institutions are going to be able to kind of wrap their hands around that business because it's just, they don't see it as often. And the fact that you're specializing in that really makes you valuable to the industry.
I agree. And when you say assets, the assets lie in the relationships. Right. And so you can't collect a relationship if that goes bad, the way you can put a building for sale or collect on a car. So that's exactly what makes our approach unique, is that we are making loans to these businesses or these individuals whose businesses consist of one-to-one relationships. And so that, I think as we continue to talk, the understanding and the importance of that relationship is a key factor in the businesses transitioning, whether it's because of succession or acquisition. But our understanding of that and the way we can essentially collateralize that. And while we're a group of pretty smart folks around here, the biggest tool we have that helps us do this is our proprietary software that helps us assess what the future cash flow streams are from these existing relationships, and then the components of those books of businesses and how they may affect the future cash flow potential from the book of business. And all of that becomes the blueprint for what we can design debt around. We don't tend to take brick and mortar in any way, shape, or form, whether it's an office building or a personal residence, as collateral for our loans. It's as isolated to the business as it can be.
That's fantastic. It's really interesting you mentioned that you have specialized software, proprietary software for analyzing that. And you think about analyzing any type of business. The more you get to know that business, one of the things I talk to advisors about all the time is specializing in serving a certain type of client. Like, pick your niche, because the better you get at serving that client, the more data points you'll have. And over time, you will actually provide a better service, and your marketing, right? Your ability to attract other clients will get easier and easier over time because you are an expert in that field, and you don't have to, frankly, going forward, work as hard to attract those clients, right?
Well, your results start to speak for you right. and gain you credibility. And for us, the utilization of technology is the spine of everything we've built this business on. So for this business, this company, to have been started by our founder in 2003, first with lending primarily to insurance agents and recognizing that their relationships, as they are reflected in insurance policies being written, the recurring revenue stream of commissions that come from that, and then essentially, could you take the demographics of those policies as they're written and predict future cash flow streams from that? That's how this all started. And then with that technology piece, though, our scalability to serve other clientele that have synergies, such as advisors with their recurring revenue streams from the relationships, and CPA firms with their recurring revenue streams from their relationships and products and services sold, allowed us to scale to growth numbers as an organization that are double digit year over year for many, many years now. But it does start with that technology piece. And whether you're a sole practitioner with 100 clients or a major institution with thousands of clients, the technology will make your efficiencies and your operations more valuable to somebody if it's something that they see scale that can come from.
That's great. So, with your focus exclusively in this space, right, in the wealth management space, and then also in the insurance space, and we have a lot of crossover we see in the clients and users of Truelytics as well. And many of the advisors, right, also offer insurance to their clients.
Mm-hmm.
You obviously must see a lot of trends, right? And as I mentioned earlier, Truelytics is a transition management platform for the wealth management industry. So, as you might imagine, many of the firms and individual advisors who use Truelytics are extremely interested in the acquisitions landscape. And I was really excited when you and I chatted about doing a show together to kind of maybe get some of your take on what trends you're seeing in the business. Like, what are some of the key trends you're seeing more broadly in the industry? Are you seeing any specific things like, an uptick in acquisitions or maybe some commonalities you see, in the deal flows that are coming your way? What are some of the, I guess you can go anywhere with it, any direction in that, but like, what are some of the trends you're seeing?
Well, I think the number one trend I'm seeing that I think anyone listening today has probably seen as well is the overall acquisition activity is increasing almost week over week. And there are at the top of that list these very heavily financially backed large acquirers who all have their own approaches, but they grab the headlines on a regular basis. And so you will have your sole practitioner sitting there in their office looking at this and on some level may think that they can't get in the game, but they can. They just are going to do it a little differently than the names we're seeing flashed across these headlines every day. So the uptick in overall acquisition activity is certainly there. And then with that, there's some multiple increases that are happening, probably a little faster than people think, but they are happening. We're looking at these deals where you're seeing revenue and EBITDA multiples increasing with each acquisition. But I think one of the biggest trends we're seeing, and we're probably driving this trend a little bit, is while it is important for a seller to be engaged post-acquisition for a while, for that acquisition to really integrate and those relationships to move over, and they still hold some sort of financial component in the overall purchase structure. There was a time where the sellers were also acting like the banks and having to almost private finance the majority of these acquisitions. And so maybe they were getting 20% down from their buyer, but they were funding 80% of it. Mm-hmm. So one of the trends I'm watching is the seller's ability to be able to realize more cash up front with the utilization of somebody like ourselves. So we might fund, 50% of the acquisition and the buyer still may be putting 10 or 20% down. And so now you have a seller that's holding a smaller portion as opposed to the majority of the portion. And so I think with that, you will get people a little bit more interested in selling a little faster because they don't have to act like the bank. They can actually realize some of their fruits of their labor by having more cash up front.
That's really interesting because, when I first became aware of, the transitions that were starting to happen in the activity in the acquisition space for the wealth management industry, it's exactly what you described, right? Usually some sort of, 20% down, or it could be higher, right? Depending upon the business. But there was some, 3, 4, and sometimes 5-year earnout period for the seller to get the rest of his or her money, basically to make sure that the clients transitioned, right?
Right.
That was the most important thing. But now, obviously, with firms like Oak Street, you have the ability for the seller to divest some of that risk, to not have to take on the risk as much, right? To be able to get more of their money up front. And there still may be some level of involvement. They're still on the hook for something, but it's not, to your point, not 80%, right? It's not like I've got to wait for, it might be something closer to, 40%, which is, a much better scenario.
Right. That's right. And less and less you're relying on somebody else to keep your business or your former business viable to be able to pay you back.
Right. And now on the buyer side, what are the advantages of that? What are the advantages of, is it because they can buy a bigger deal because now they have access to financing? Is it the financing can be spread over a longer term and therefore they can get to cash flow positive on the new business faster? What do you see as some of the major advantages of kind of this change in structure?
So I'm wishing we could see each other. You see me shaking my head right now because it's a yes to all of that. But I think the second thing you hit on is important. Or companies like ours can structure debt for the structures can be different than what sellers are accustomed. As you mentioned before, maybe they're on a 3-year or 4-year, kind of this rapid reduced repayment structure, which is in the best interest for that seller as they're acting as the bank. But for us, for someone to take that same debt and maybe have it amortized over 10 years, so it's a little bit less onerous on the day-to-day cash flow or the annual cash flow as they're trying to make those seller payments. Also, with a partner like us, we can help continue to facilitate additional debt to make at least a portion of those seller payments that are out in the future. So it does, I think, allow them to leverage the business in a way where they can essentially get a little bit more than maybe what they could before because of the way to have the debt elongated compared to private financing.
Smart.
Yeah.
It really does. I love the fact that it actually makes the M&A market, right, a little more vibrant, a little more liquid, if you will.
Absolutely. And go ahead.
Oh, no, that's fine. You continue your thought. I'll
I think the other piece that can come into play around some of these trends and the sellers, they're just the ability to be able to receive a little bit more cash from somebody on the day of funding. I don't know how much it really at this stage plays into how much of a price they might realize as well. So if I'm having to do it one structure versus the other, I've certainly seen it where prices are going up or down accordingly. If the seller's holding a lot of the note and they're getting paid over time, you may find a different price in play than if you're able to help them realize some cash out sooner.
I get it. Yeah, like it's that old time value of money thing, right?
Right.
Money, $1 today is worth way more than $1 5 years from now. So if you can pay me faster, I'll take a slightly lower price.
That's right.
Very cool. So, we've kind of just bled into this, but, look, there's always two sides to any acquisition, the buyer and the seller. Along the line of trends, are there any things that each side, like the seller or the buyer, should keep in mind as they explore buying or selling a business, right? Are there any potential landmines they should be aware of, or maybe even like the concept, like who should lead the dance, right? Like who's kind of in charge, if you will, or I don't even say has the power, but which side should be driving the process, or should it be equally collaborative? What are your thoughts on that?
I mean, I definitely think it has to be collaborative, but I think people don't know what their role is in the collaboration. So they both have priorities that they're trying to realize. So as the buyer, we work mainly with the buyer. So in my point of view, the buyer is in essence leading the process. But the seller certainly has a huge influence on the process and the direction it can go. So, some of the things early on, the landmines to be aware of, or the pink flags, as I put it, because it might not be a reason to not go forward, but it's certainly a reason to pause and ask some more questions. People sometimes forget to ask, and why is the seller selling? Don't assume age is the reason. So, asking some of those questions that feel like they should be so obvious to understand and know, but when you hear somebody explain, you may approach your acquisition a little differently. And this is really particular to how the relationships will transition. So, is the person not only willing to, stay on in an employment role for a couple of years, but what will become your plan? Who do they think you should meet first? They know these people more than you. Are they connected to their people the way you're connected to your people? And by people, I mean their clients. And making sure this transition can occur. So in that case, the seller's now leading the dance because they're going to make those introductions and start facilitating the handoff of that relationship. And so what does that mean? So, it is a lot more than what most people, I think, get very focused on price and structure, but the overall integration is where the success really can lie, or can live and die. And so in there, that's where you truly need that collaboration.
That is such a smart kind of distinction or detail to mention, right? Is, you're buying this basically future cash flows, as we talk about here at Truelytics. Like, that's what you're buying when you're buying another business. And you really need to make sure that future cash flows that you bought are going to be stable and hopefully growing, right? That you don't want to buy something that ends up being worth 70% of what thought you bought a year from now. So you want to make sure, like, yes, price is important. Yes, deal structure is important, but really, really important that you focus, like you say, on the integration and the adoption of those clients into the new business.
That's right. Because it's going to be a focus. So then how are you going to balance taking care of your existing clients while you're getting to know these clients? What is the plan, and can both buyer and seller agree and stick to the plan? And then recognize that all the best laid plans don't always go that way. And so when you need to pivot, are you both interested in doing that? So really understand the nature of all these businesses are the relationships. And I do believe that the buyers and sellers have to formulate a relationship as well, because they do need to work together at certain stages and at certain extremes. And so figuring that out, we talk so much about the client transition, but there's usually also a staff transition that's occurring as well. And so who are the staff members that the new buyer needs to understand who they are, where they're coming from, assuming that people are staying on. And, I apologize. Assuming that people are staying on, and how do they get to know the staff? How do they get the buy-in of the staff? How is the seller supporting even their migration into this new business that might have a new culture, new systems? It can get quite disruptive. So who's working together to limit that?
Yeah, it's interesting. We just had another guest on the show, and that episode will be going live soon, up on iTunes and Stitcher and everywhere you get your podcasts. And she leads a company called Cruise Consulting Group, and that's what they do. They focus on the talent wealth of wealth management firms, right? Of like, what does your employees look like? How integral are they to your business? How do you get the most out of those people? We actually talked about that, exactly what you just described, which is, when you're thinking about transitioning your business to someone else, either through acquisition or a succession plan, talent matters, right? Like, are they going to stay with the business? And if they are going to stay with the business, their value is part of what somebody is acquiring, right? They manage relationships just as much as the ownership group of the firm do.
Absolutely.
So speaking of transition, kind of keeping that ball rolling, what a timely thing. I saw an article this morning in my newsfeed talking about this great transition wave that we see coming, where it's estimated that 40% of all advisors will be retiring in the next 10 years just due to age. And some of the things that firms are doing to recruit younger advisors to make sure they backfill that gap. But, we spend a lot of time talking about that here at Truelytics, because it's inevitable over that decade that, we're talking tens of thousands of advisors are going to be leaving the industry. Voluntarily or involuntarily, right? I mean, just the way life works, father time is undefeated, as they say, right? So, but from a funding perspective, as I can't imagine, I'm not, I'm Gen X, I'm not a baby boomer. So I don't know quite what it feels like yet to be going, hey, wow, I've probably only have 10 years of, peak work life left, if you will, to before I leave. But I can imagine some of those folks are suddenly, I wouldn't say quite hitting the panic button, but what's the button next to the panic button? The urgent button, right?
It's not the easy button, that's for sure.
It's definitely not the easy button. It's like, oh crap, I'm 60 years old. I guess I should start thinking about, that those last couple of holes of the golf course. So from your perspective, the funding perspective, how should these folks prepare? Is there anything that the outgoing generation of advisors could do to make it easier for another advisor to acquire their business? Is there something they should be doing ahead of time to kind of make themselves a little more attractive, if you will, or get their ducks in a row, the proverbial ducks? What are your thoughts there?
I think two things around that. One is, are you going to prepare your business to be sold, or do you want to prepare your business for an internal succession plan? If you're in both cases, you have to kind of clean the house up a little bit, right? So if you are preparing to be sold, it comes down to some little things. Get yourself organized, have your financials together. If you are not growing clientele, be ready to explain that so that a buyer can see potential in your business as well. A growing business may have more value than a flat business. And if you are losing clients, be ready to understand and explain that and what that means for the value of your business. And that, those things are important. Be prepared to be honest and transparent with a potential buyer when it's appropriate. At the first time you have coffee with someone, I don't know that you necessarily spill all the candy, but you're going to have some, you should have some pretty tough, in-depth conversations and be prepared to do that. Also, have a team of people around you that will be able to help you do this, whether these are attorneys or accountants. You don't have to do this alone. You don't have to break the bank to do it either, depending upon the size and scope. But there are a lot of resources out there that people could take advantage of so that they really do have a finger on the pulse of their business, the health of their business, maybe even the potential value of their business, and they're not going into anything too blind or with two rows of colored glasses and thinking they're worth more than what they are.
Right.
The succession piece, if you're going to bring kind of that next generation in, or you have someone there, then I think you have to really engage with them about what that development plan looks like and outline it. And if you don't have someone there and you want to find someone, most likely you want to find somebody that can help you find that next generation. That's a lot easier said than done. I've sat in many a workshop where you're hearing people being told, by a show of hands, how many of you have found the next generation who's going to come in and take over your business? And nobody raises their hands. And then there's a lot of conversation around you're not looking for the right person. You built your business. You don't need to find the younger version of you. You need to find the next version of the person who's going to take your business to the next level. And they're not recruiters. They're entrepreneurs and they're business people, and they've developed themselves and some people around them, but maybe they're just not cut out to find that next person to then bring them along. So if you're not, that's okay. Just kind of know that and then move forward accordingly. So you have to explore what you want to do. And then at the heart of it, I think one of the biggest roadblocks is just the emotional step that happens as you're essentially entering retirement. Especially if you have built a business, most of your life has been taken up with running these businesses, building these relationships. What will you do with your day-to-day when this is no longer your day-to-day? And exploring kind of emotionally how this move will affect you, your family, your coworkers, your clients, and how do you want to define yourself at that next chapter? And so that gets a little bit beyond, what the multiple is, or I got my tax returns together, but that's what comes into play, I think, across all of this transition of ownership.
That's some really smart advice there. And I didn't think you'd go there, but it's so true. We kicked off this podcast talking a little bit about sports, right? In Indianapolis. And, you see that with aging athletes a lot, right? They've been extremely successful in their business. And towards the end of their career, some of them have a real hard time recognizing that, okay, it's now time to transition into maybe coming off the bench, being a role model for the younger team members, right? Training the next generation. And then eventually it's your turn to step aside and let them lead, and you go do what you're going to do afterwards. And I can only imagine that if you've been an advisor or an athlete for, 30 years of your life, and suddenly you're not that anymore, there is some challenges with that. And so what you suggested all really makes sense. That, look, first of all, you start preparing your business just as you would prepare a house and for a sale, like staging the house, painting walls, making some new things, neutral colors versus, the vibrant pink wall you may have because you just like pink, right? So you're gonna prepare a few months ahead before you sell your house, and the same's true. You're gonna prepare your business, but you would never sell your house and not know where you're going.
Right.
Yeah, you're going to have some other housing concept lined up, right? And so I think your advice is incredibly sound. I'm glad you went there.
Well, as we were speaking about technology earlier, it's not easy to shift your business on a technology platform. And so you could have spent years doing this, and that's where you have a lot of your own pride and joy. But you're an acquirer. If you're a seller, that acquirer has their own technology they like. And they may not adopt yours, and so they may not see the value in that. And so it's being able to kind of keep both lenses going and understanding where you see value versus where they see value. And making those walls a little bit beige because you want to attract a lot of opportunity for yourself. And as a buyer, recognize you're not buying the wallpaper, you're buying the house. So if you don't like something, being able to discuss, what you would do about that piece. You don't want to throw the baby out with the bathwater, so to speak, just because there's ugly wallpaper in the dining room, right? How do you fix that? This business has everything you want except that piece of technology. Okay, so let's figure out how to work around that. And so it is kind of, taking a little bit of a deep dive. Now, with that, you're having to build some trust with each other. So, how you find buyers and how you find sellers and how you start to formulate those relationships so you can get that deep with it is a really important stage as well. And right now, I think you have a lot of people who want to sell, but they're not making that evident. They're not vocal about it. They don't want to upset their clients, their staff. And so I call them secret sellers. So you kind of have to also figure that out too. Where are the sellers? You certainly hear about the buyers every day, but how do you find those sellers?
Well, and that's a really important, thing to mention that, and I've talked about this actively, is that, you need to be careful letting the world know you're for sale, right? Because once you let the world know you're for sale, employees start getting nervous, thinking about, should I change jobs? Clients start getting nervous, like, should I go look for somebody else to help me with my finances? So you do need to be cautious there. So there's definitely a more kind of under the radar approach to doing it and developing relationships. And I actually wrote a blog post on the Trulytics blog about this concept before, about starting to build your relationships with potential would-be sellers much earlier than you think you may need to, right? Start networking with people who are have businesses that look like yours or that are maybe a little smaller than yours. Or if you're thinking of, or a little bigger than yours, if you want to sell, because usually a bigger firm buys a smaller firm, occasionally same size, but it's rare that a small guy is going to come in and buy the really, really big guy. So make sure you're kind of preparing yourself well ahead of time. That kind of leads us right into the next kind of the flip side of this conversation is the young advisors. I've met many young advisors who are aggressively thinking, this is the way I'm going to scale. I'm going to go out and buy up some of these older advisors' books, these advisors who are exiting the business. I'm going to acquire a few of those and go from 0 to 100 real quick. What are some of the best ways for them to start preparing for such an endeavor? And should they kind of do it piecemeal, like buy one, digest it, wait a few years, buy another, digest it? Or what do you think kind of the process they should follow is?
So I want to say, buy one, digest it. I don't know that you have to wait a few years for the next one, though. What they want to do, if they know they want to go about doing this multiple times, is really hone in and figure out what their integration plan is and what their model is for buying. What are they buying? Are they just buying assets no matter where they are? Is there a particular kind of clientele they want? Is there a particular custodial relationship they're looking to get into? What is motivating the buy besides growing their assets? And then from there, get laser focused and try to, meet those people. But it's the integration. I just keep going back to this, and it's really redundant at this point, but it really does live and die on that integration. If you can acquire and integrate pretty seamlessly, and you can start to do that rapidly, then you don't have to buy one a year. You could buy a couple a year. But you do want to make sure you just don't get out over your skis. What can certainly happen is one of two things. One, you want to buy something and you're looking forever and ever and ever. And you don't see something for a long time. And then suddenly something pops up and your judgment starts to get clouded and you buy something that wasn't really what you intended to do in the first place.
Right.
And then you might end up with a little mess to clean up there. The other thing is you get a little bit confident and you buy something that's just a little bit bigger and just a little bit bigger. And maybe now you're not paying attention to any kind of client concentration issues and you do lose that one client and it has an impact. And now that's a huge distraction and you're trying to integrate 3 or 4 of these essentially at the same time. So, trying to just stick to something that's working and don't get ahead of yourself. And don't let your judgment get clouded when it isn't happening as fast as you want it to, that you start making bad decisions. So get what I call an accountability partner who helps you keep that focus. So if you're starting to sway, they'll ask you why. And if you both agree that the why makes sense, then you may just do it. But, you need someone to be bouncing some of this off of as well, who's neutral to the process.
That's really smart. My friend and I call that your chief nope officer. Everybody should have a chief nope officer where you're like, hey, listen, I'm thinking about buying this big business. Most of the clients on the books are like 75 years old and no, they don't have any relationships with the heirs. What do you think? Nope. You're like, I know it's a 30 million AUM that we could add really quickly, but most of those clients they're probably in net redemption and they're going to die off. Why don't we go with the nope on that, Fred? Like that.
That's right. I just recently had someone tell me they have a rubber ducky on their desk. And as they start to think through something, they tell the rubber ducky about it. And if they already can't believe what they're saying, it's simply saying it out loud sometimes makes you your own nope, chief of nope.
That's hilarious. That's great. Well, this has been fantastic. So, as we wrap up here, kind of in closing, what do you like? If you have like one piece of advice or one kind of guiding principle that every wealth management team and individual solo advisor should keep in mind as it relates to acquisition, kind of what's that? What would you say? Do you have one thing?
One thing.
Keep this in mind.
As it pertains to ownership transition?
Yeah, ownership transition. Like, what's the one thing to keep in mind you think that everybody should always never forget about transition?
Yeah, never forget about why you're doing it to begin with. If you're there because you're passionate about it, tap back into that passion about why you're doing it. And as people in the process are asking you questions, whether it's lenders or attorneys or CPAs or sellers or clients, don't get offended. Answer the question, right? And keep moving forward. There are a lot more people involved in it than just you and your team. But yeah, just being organized so that you can execute and being disciplined and listening to others, getting that accountability partner, whether it's another advisor or an attorney. And by attorney, I don't necessarily mean some hourly rate person you're paying like you would your psychiatrist, but rather someone who at least has an understanding of what you're experiencing to keep you there and to keep it successful. And just always remember why you're doing what you're doing. And if it's important to you, keep moving forward with it.
I love that advice. It's so easy to lose sight of why are you entering into this process in the first place? Why are you looking to acquire another business? Why are you looking to exit the business? And that's kind of your motivating factor. And all the other things, the details involved are meant to serve that purpose.
That purpose, right? Exactly.
That's fantastic. Well, thank you so very much, Kirsten. I know 100% that people are going to want to follow up with you. This is, again, is one of the number one topics we hear about where people are really, really interested in transition, either through acquisition or through some sort of internal succession planning. And I know that Oak Street Funding can be of assistance. What's the best way for somebody to reach out to you and follow up if they want to?
So if they want to reach out to me directly, they can really call my office, which my phone number, if you want me to give that out.
Yeah, go right ahead. Sure.
That's area code 317-428-5156. So at 317-428-5156, they'll get to me. My team, however, and not just our relationship managers, but also our lead underwriters, you can find their profiles and contact information on our website, which is oakstreetfunding.com. And they can be a tremendous points of contact for people that have questions. I'm fortunate enough to be here and be in this world, but they are in the nitty gritty of it every day, and they are truly shepherding people to realize these strategies by getting these debt vehicles put in place and letting these guys go forward and grow their businesses. So they're great points of contact here as well. I'm really proud of my team.
That's awesome. You guys on social by any chance? You're on LinkedIn, Twitter, and the like?
We are on LinkedIn. Sorry, I didn't think about that. And Twitter at OS Funding. I can't say I know my Facebook page by heart, to be honest with you. I've taken a break from that.
Oh, that's okay. Well, I really do encourage, any listeners to actually, go out and follow Oak Street Funding on LinkedIn and Twitter and wherever else, whatever preferred social media platform. Because I always find whether it's, Oak Street Funding or Truelytics, it's a great way to just kind of stay on top of what the company's doing. I'm sure you guys are sharing lots of informative stories that are relevant to the industry, and people should sign up for your newsletter if you have one there on the website as well. But because, look, as I said before, not everybody's in the market to enter into a transition right now, but eventually everybody will be. At some point in time, you will transition out of your business. So you'll be at least on one side of this process. So the more informed you are, the better.
Yeah, absolutely right. And on our website, on our resource page, we have past newsletters. There's a way to sign up to get our newsletters. We put white papers out about a lot of the things we talked about today, right? We lead with content. We like to consider ourselves experts in this lending space to this clientele. And so the content that's out there certainly is accessible, free, and might just at least validate what somebody's already doing. And if that's what it does, then it's serving its purpose.
Perfect. Well, thank you so very much for joining us today. And I look forward to chatting more in the future.
Thanks a lot, Mike. Have a great day. I really appreciate the opportunity to talk to you today.
Thanks. All right. Huge thanks once again to Kirsten Bayer-Petras for joining us today. I know I got a ton out of this, and I hope you did as well. For me, as a guy who spends a lot of his time thinking about the future, right? That's kind of like I kind of wear a hat where I consider myself a futurist, if you will, really looking at what's happening today, what's happened in the past, and kind of trying to draw that line of like, where is the world headed? That 40% number of advisors that will be leaving the industry in the next 10 years, it's real. And our industry is going to change dramatically. And you have the opportunity, if you're on the in the 40% that might be leaving the industry, to really shape the way you transition your business and your clients continue to be served in the future. So really do think about that, because many of your clients are not going to be retiring their financial lives when you decide to hang up your cleats, so to speak. On the flip side, if you're a younger advisor and you're thinking of growing and scaling your business via acquisition, this is really the time to start thinking about it, because there is about to be a lot of opportunity for you to buy other advisors' businesses, who are those advisors who are looking to retire. You're going to have your picks, so to speak, but you really do have to dig in, do your due diligence, do your analysis, trying to ask yourself, what type of business do you want to be running here in the next decade or so? And then you can shape that, right? But take this type of stuff seriously, because it's going to happen faster than you realize, right? Think about 2009. That was 10 years ago. And think about how recently that feels. Like, go look at the movies that came out in 2009. You'll be really surprised. Wow, that movie is 10 years old. I didn't realize it was that old, right? So pay close attention, right? We just finished up the last couple episodes. I mentioned Game of Thrones, right? We just finished up Game of Thrones like 2 weeks ago. Well, Game of Thrones was on for almost 10 years, but it went by quick, didn't it? Right. So that 10 years with these advisors are going to be transitioning out is going to go by really quick. So that opportunity is going to evaporate quickly, and the industry is going to look dramatically different in a very short amount of time. Okay. Hope you enjoyed the show. As I said, send in your thoughts at valuations@truelytics.com. Hit us on the socials, Twitter, LinkedIn, Facebook, or swing by the Truelytics website, truelytics.com, and click the contact link and let us know what you think. Okay. Hope you have a great day. We'll talk to you soon. Bye.